Ridham Desai of Morgan Stanley. Ridham, fantastic to have you back and thank you for joining us. Ridham, it's just been a strong and a super comeback by the bulls. The fact that we are nearing an all-time high on the Nifty, it was least anticipated in the run-up to the budget. What do you think is going on? Are markets changing, are prices changing the opinion, or the opinion has changed and that's why prices have gone higher?
Yeah, thank you, Nikunj. Yeah, great to be back on ET now. I think it's a very good question you're asking. So prices change the opinions, I think in large part. My experience of doing stock markets for 30 years is that prices lead almost everything. They lead economic growth, they lead economic forecast, they lead earnings forecast, they lead sentiment, they lead flows, and they lead opinions. So I think the inflection point was probably 27th of February. And I think that incident changed the market's opinion as prices also started inflecting that India may be voting majority government or stronger government back to office. Prior to that, I think the market was not very sure that India was going to vote strong government, and we were looking at the prospects of a broad coalition government. So the fact that the probability of the election result has tilted in favor of a majority or a strong government, I think has clearly shifted the sentiment. We've had a few things that have happened, of course. I think we're heading into stronger growth. Now, mind you, I've been arguing for stronger growth for quite some time and have been totally wrong about it for various reasons. We'll not go into those reasons, but I think now we are at a point where the growth cycle is looking like it's inflecting. It may have already inflected, and I think we will see that in headline earnings growth over the next several quarters. So we could quite be at the beginning of a pretty strong growth cycle that may last for 5 or 7 years. The previous cycle, which was the down cycle, lasted longer than it should have, and I reckon it probably lasted for about 7-8 years, starting in 2010 and probably ending only in 2018. So the markets cannot fully price in a new growth cycle, but the market does have some inkling that growth is improving, and some of that is also getting reflected, I think, in share prices. The thing to worry about, of course, is oil. And we have to keep an eye on that, and maybe we can discuss that in this conversation later on.
Thank you for that introductory remark, Ridham. I just want to mark the market breadth, and the market breadth is not exactly looking all that charged up. The market breadth has slowly started caving in. Ridham, everybody talks about the importance of election, and you track market data much more than anyone else perhaps does on D Street. And both of us know that the impact of election is always in the short term, and 8 out of 10 times markets have gone up after the election cycle. Then what is this hullabaloo all about? Because institutional investors who say we don't look at weeks, we only count years and decades, why are they so bothered about election cycle?
Yeah, it baffles me as well, Nikunj. And I'm in conversations with various investors, and we've spent a lot of time over the past 3 months discussing about the outcome of the likely outcome of the elections in 2019 May. The honest fact is that nobody knows. Even the most educated and brilliant cephalologists in this country really cannot call the elections with any guarantee. So for an event where the outcomes are so hard to assess, I'm actually surprised that so much time is being spent debating those. And then the point that you make on impact, where clearly from a stock market perspective, it all depends on what gets priced in. And what we've seen is that hitherto the markets have not necessarily gone with a very strong view on elections, save for say 2004 and 2009, and to some extent 2014. But if you go back longer term, the markets tend to take a little bit more neutral stand and not really trade strongly into elections either way. Now, if this market chose to trade very strongly into May, then the risk actually is that in the short run it may come off post-elections, irrespective of what the result is, because it's like buy the rumor, sell the news. But yeah, you're right. Elections have a short-term impact, but investors do care because of the likely gyrations in the short run. A lot of people that I talk to are very focused on near-term performance, while also trying to extract long-term performance. They don't want to ignore the near-term impact. Now, with regards to the fundamental impact, I think there are two things to watch out for. I think this is far more important than what the election outcome is. The first is what a new administration does with respect to the inflation framework. Now, we are exiting this 5-year period with very benign inflation, thanks to positive real rates and thanks to hyper control on food prices. A new administration may have a different view on how to manage inflation. To my mind, actually, we have gained a lot as an economy from this lower inflation. We've gained macro stability, and we have probably put in a trough for growth. If the view on inflation changes, then it may have impact on how growth may pan out over, say, 3 to 4 years. The second is on the fiscal side. There has been both a shift in the quantum of fiscal spending as well as the quality of spending. So we have made a subtle shift from social spending to capital spending or infrastructure spending, and we've also brought down the fiscal deficit, and a new government may also have the choice to change that. So to my mind, those are the two things to watch out for. They do not actually bring any immediate impact on share prices, but they could impact share prices over, say, 3 to 4 years. Aside from that, really, I wouldn't be too focused on the election outcome, except for the likely trade that will take place in the market between now and, say, May.
Ridham, morning. I was just going through some of your notes and some very interesting points that you make. You're saying that the market is not oblivious to a new earnings cycle, but it cannot price in just yet. Explain to our viewers, do you believe that the market is sitting at the cusp of a profit cycle, and what convinces you that we are at the beginning of this much awaited profit cycle to begin with?
Okay, so I'll take the second question first.
Sure.
Assessing what's priced into the market is a lot harder. So I think we've come to the end of a big drawdown in investments. The government has counter-cyclically spent on infrastructure investments, and if you look at public capex, which is the aggregate of central government, state government and public sector enterprise spending, that number is actually now at multi-year highs. So we've seen counter-cyclical spending from the government on capital, and capacity utilization in the private sector has been rising for the past 2 or 3 years. The balance sheets seem to be depleted in terms of capital stock, and give another 2 years, utilization rates across several sectors will be in the 90s, at a point of time where companies will actually need new capacity. And you need to start planning now, because it takes about 2 to 3 years to put up new capacity. So I think post-elections, we may probably see companies start spending capital on creating new capacity. Now, there's a very strong correlation between profit margins and investments. So if the investment rate is going to go up, which is what we think it will also cause margins to go up. Mind you, revenue growth put in a bottom almost 8 or 10 quarters ago and has been accelerating since then, because nominal GDP growth has been improving over the past couple of years. So it's not about top line growth, it's more about corporate margins which have been suffering. So this is the most important premise to why we could be at the beginning of a new earnings cycle. To put it to put it differently, the share of profits in GDP is about the same level as it was in 2002-2003. It's about 3% of GDP. It peaked at close to 8% in 2010. The ride from 3 to 8, which happened between 03 and 2010, resulted in nifty earnings compounding in excess of 35%. Market earnings growth was that strong. Now, we don't think that type of a growth may happen this time, because we don't have the same support from global factors. Mind you, in that period, global growth averaged about 5%. At this stage, it seems like global growth is more likely to average 3%. And therefore, I think a more modest nifty earnings growth of about 20% compounded over the next 4 or 5 years is not out of reach. So that is on the second part of your question. Now, on the first part, it's always difficult to assess what's priced in. And given that earnings are very depressed, I don't like to use the P ratio to ascertain the market valuations. I prefer using price to book. Now, where are we on price to book? If I use the Nifty or the Sensex, price to book is about 3.1, 3.2 times, which is bang in the middle of its historical range. You know, in 2002, 2003, the Sensex was trading at 2 times price to book, and earnings were depressed. It was a no-brainer to buy stocks then. It took a while, and there was pain for maybe 12 to 18 months, but then you got a ferocious rally in stock markets, and the Sensex went up 7-fold in the subsequent 5 years. I don't think that type of return is on hand right now, because the price to book is already at 3.2, it's not at 2 times. So that gives me a feeling that the market is not completely oblivious to the coming earnings cycle. It knows that it's coming, but it's not at 4 times price to book or 4.5 times that the Sensex peaked at in 2007, when it knew that the earnings cycle was on it, and it was fully priced in. So we're kind of somewhere in the middle, and that's what gives me a feeling that, yeah, some of it is known to the market, but not all of it. I think by the time we are done and dusted with this bull market, it is quite possible that the Sensex price to book multiple is over 4 times, and the Nifty earnings or Sensex earnings have compounded by maybe 20% for 4 or 5 years. So I think that's the framework that I have in mind with respect to earnings and valuations.
Ridham, I know you spoke about the overall investment grade going up and that being, the precursor for the overall earnings growth. But let's wind the clock back and talk about some big events that have taken place that have impacted market sentiment. Over the last few years, we've seen demonetization, GST, you had the IL&FS crisis that played out. Now with the big election event coming up, do you think that to a certain extent it could delay the earnings cycle recovery?
In fact, I think unless we get exposed to one of these shocks, which I would, which say, for example, demon or GST, I don't think that's likely to happen, and therefore I think the earnings recovery is not going to get stalled just because there is an election event in front of us. Of course, if the country chose to put in a fragmented coalition government, like it did in, say, '96, then that could be a problem, because then I think sentiment could get really bad, and a lot of decisions that companies make with respect to investments could get delayed. So that's one downside risk that we have to deal with. In the near term, as I mentioned at the start of my conversation, the other thing that we have to worry about is global factors, which is one is oil. I think we are at a stage in our economic cycle where we have limited tolerance to, to poor terms of trade. So if oil continues to outperform copper, which is my signal that there is a supply side issue with oil, which hurts India, then that could, cause a little bit of a problem. The other thing, of course, to keep an eye on is global growth. Indeed, at this point of India's own cycle, it does not want global growth to slip into recessionary territory. So keeping those caveats that A, we don't vote in a fragmented coalition government, we get some reasonable strength in the government, and we don't have to stare at elections in, say, 2 years from now again. We don't get a global recession, and we don't get a sharp run up in oil prices. I think the earnings cycle should be reasonably in good shape over the next 1 to 2 years. I'm not assuming that we'll get a demon or a GST type of shock that we got. In fact, when I said that we've gone wrong on earnings, it's primarily because of the demon shock, which then got coupled with GST and caused the economy to slow down a lot more and for a lot longer time than what we had anticipated. So I think those shocks have been absorbed. You mentioned about IL&FS. So I actually think that the NCLT, whole NCLT bankruptcy process has actually been working quite well. And we are now seeing some good test cases, whether it is IL&FS or it is Jet Airways. These are situations that were created after the passage of the bill. And I am actually quite pleased with the way these things are being handled right now. And it actually suggests to me that unlike past credit cycles, the next credit cycle may actually be far shallower because banks have now got recourse like they never had before. So that actually makes the whole banking sector very interesting in my mind across the board. So I'm not too perturbed about what has happened with the IL&FS. Yes, of course, it was a problem with liquidity and problem with non-banking finance companies' balance sheets, but a lot of that I think has now been absorbed and is behind us.
Ridham, I like to draw your attention to the market movement. Corporate banks are looking better. L&T is moving slightly higher. HUL is underperforming. Page Industries is down. iShares is cracking. Are we at this final turn in market pattern where money will start migrating out of some of these halo stocks? You've been making this point from 2016 and 17 that the obsession with quality has to come down. Are we there yet?
So Nikunj, if the cycle is turning as we are opining, then clearly there will be greater value in pursuing cyclicals, whether it's the financials, which include the banks, the non-banks and real estate, or it is the domestic cyclicals, both on the consumption side as well as on the industrial side. So clearly those are the places where I would think that you want to put money to work with a 1 to 2 year view. And for that time, the companies that focus on maintaining pristine balance sheets and high return on capital may actually take a back seat. More so because a lot of those stocks of those companies trade at pretty high valuations and may not have the same earnings momentum as the cyclical bit of the market may have. So yeah, I think this could be a continuing trend where money actually migrates to cyclical side of the market away from the so-called defensives or high quality names.
So Ridham, closing comments. What do you think a 3-year portfolio should look like? A tilt towards defensives, a tilt towards cyclicals, a tilt toward exporters? What would be the heart of that portfolio?
So Nikunj, as I said, I think I'll buy financials, and financials is a pretty big sector because it includes the banks, especially the banks that suffered the most during the previous NPL cycle. It includes select non-banking finance companies. I'm not writing them off. In fact, I think some of these non-banking finance company stocks have now become quite reasonable in valuation terms, so you should look at them selectively. And it also includes real estate, where I'm actually quite bullish because I think both the commercial and the resi real estate cycles have put the bottoms in. In fact, I think the commercial bottom is now well behind us, and it's clearly in an ascent. And resi is, I think, putting in a bottom over the next few months. So there should be quite a lot of interest in real estate as well. And then the other portion of the portfolio will be occupied by domestic cyclicals, which include consumer cyclicals, which, if I were to expand on that, means autos, auto parts, entertainment, travel, leisure, things that people spend on a discretionary basis versus, say, staples, which they need to buy on a daily basis. And then domestic industrials, because I'm quite constructive on new capex cycle. So industrials across the board, which includes engineering companies, includes construction companies, includes equipment companies, a whole lot of companies that are sensitive to the industrial economy. So I think that's what the portfolio will have. What will it not have? We've been underweight technology, and I'll continue to avoid technology for now. I think I'll avoid global commodities and global energy. And probably also avoid utilities, excluding, say, the gas pipeline companies, which are, witnessing a more secular trend. So that's probably what I'll avoid in the portfolio with a 2 to 3 year view.
About the biggest joker in the pack, that's crude. So far well behaved, but slowly it's crept up to a 2019 high, and we are circling around that 67 mark on the Brent.
Sorry, I missed your question.
No, I was just talking
that?
about crude and the significance, and would all these assumptions fail if crude were to spike up further? Because it's already crept up to a 2019 high. We're quoting around $67 per barrel.
Yeah, so I think that's clearly a risk. I would not ignore that risk, and we need to keep an eye on oil. And if there is more supply disruption in the oil market, then that's not good news for India. You know, so far as oil is going up because global demand is strong, I think that's better tolerated by the Indian economy. What the Indian economy does not tolerate well is the supply side thing. So yeah, we have to keep an eye, we cannot ignore it. I think 67 is okay, but if this starts nudging into the mid-70s, then I think that will get into a bit of a problematic situation for India.
Ridham, if I look at the current NBFC crunch, do you think it's like a train wreck, or now the adjustment is over, rates will contract, liability franchise will come down, but ultimately NBFCs will come back, and the ones which will come back, they will be formidable, they will be bigger. And you know, up until now we've looked at NBFC 1.0, but now we could be looking at NBFC 2.0.
So Nikunj, I think there are two parts to this. So firstly, I would not characterize it as a train wreck. I think in October, November, a lot of people thought that there's going to be a blow up in the sector. As you wind forward into March, there hasn't been a blow up. So clearly those were exaggerated negative views. Yes, of course, the balance sheets had to shrink. The NBFCs had to build more liquidity and slow down growth. And consequently, the share prices took a big knock, and a lot of share prices fell between 50 and 80%. So, you know, the stock prices reflected the fact that at least for the next 12 months, a lot of the non-banking finance sector may not be able to grow their balance sheets because the market will demand greater liquidity on the balance sheets and also more capital. So that adjustment has happened. So now I think we have rebased in a lot of cases, and now we have to look forward to what could happen in the next 12 months. So I think credit demand is likely to be quite strong because the economy is recovering. So the overall macro is getting better. For now, interest rates are soft, but I don't think that will remain the case as you go into 2020. And to that extent, the banks who have ready deposit franchises will be better placed. So if you're asking me to compare between banks and NBFCs, I think clearly you want to buy banks because rates are moving higher in the next 12 to 18 months rather than lower. And to that extent, the NBFCs have come out of that sweet spot that they enjoyed for 3 or 4 years when rates were actually softish. The other thing that we have to note is that NBFCs also gained because the public sector banks were short of capital and were struggling with their NPL cycle. I think a lot of that pain is also behind us. So to that extent, the NBFCs now will have to compete a lot harder for growth. So clearly, it's cyclically not the best place to be in. Structurally, I don't think there is a problem. So those are the two parts to the NBFC story. So between banks and NBFCs, I'd still prefer the banks. But you know, as I said in my conversation, you have to also pay attention to what price is being attached to some of these businesses. And I think in certain cases, the prices have become quite attractive. And therefore, you know, you want to buy them selectively into your portfolio. So it's not like 2014 to 2017 when you could buy NBFCs and any NBFC actually gave you a lot of returns. I think there's more selection required now.
Okay. Ridham, fantastic to have you on ET. Now I certainly hope to see much more of you going forward.
Thank you, Nikunj. Thank you.